then you buy it. So you don't buy things that you can't afford, and don't lease a car. If you're now, leasing may make sense as a business write-off. If you actually need your car for business and you can write it off, it may be a better write-off. And sometimes leasing makes sense. But for most people, they should not be leasing cars. It's a mistake. And they should not be borrowing money to buy cars. Just buy the car. Instead of putting $5,000 down on a $40,000 car, buy a $5,000 car that was a $40,000 car 8 years ago. Yes, it's not going to have all the brand new electronics, but you know what? You can't afford all that. Don't borrow money to buy depreciating assets. That's a mistake. That's how poor people stay poor, right? You want to get rich, you borrow to buy income producing, appreciating assets. That's when you borrow. You borrow to make capital investments that pay for themselves. You don't borrow to consume. You don't borrow to buy stuff. Buy the stuff that other people borrowed when they sell it, because you can buy it for 10 cents on the dollar, right? Be smart with your money, right? That's why you're listening to me. Should I worry about my brokerage account, which holds the gold investments at Interactive Brokers? No. I mean, look, I think Interactive Brokers is fine. We use them. I use Interactive Brokers at Europe Pacific Asset Management. So we have customer money there. I don't think any of these big brokerage firms are going to fail. I mean, some of them might if the government wasn't bailing them all out, but they're all going to get bailed out. The government's not going to let anybody fail. Instead, the money is going to fail. That's the point I'm trying to make. Don't worry about losing your money. You're not going to lose your money. Worry about your money losing its purchasing power. That is the risk. That is what you need to guard against. None of these government protections, none of these bailouts, none of these guarantees can do anything about that. All the government can do is guarantee that you get your money. In fact, it reminds me, in The Biggest Con, my dad's book from 1976, right? My father reproduced a page out of the congressional record, and it was taken from debates in the 70s about Social Security. And they were talking about what they're going to do about it. It was running out of money and they needed to do something. And William Proxmire, who was the head of the Senate Committee on Money and Banking, he was a big senator in his day. Most of you listening to this have no idea who William Proxmire was. He was a big senator, right? And he said on the Senate floor, I'm not making this up. I read it with my own eyes in the congressional record. And I not only did I read it in my dad's book, but in his office when I was a kid, I read it in the exact, congressional record that he ordered from Congress. They shipped it out. Congress printed it, right? You can get these congressional records. They make a book out of them. At least they did back then. Maybe it's on, you can get it online now. But my dad ordered the volume that included this, right? As to have an exhibit for his book. But William Proxmire, talking about Social Security, this is what he said, and almost quoting it verbatim. He said, the United States government has an invention called the printing press, and we will use it. All Social Security benefits will be paid. They may not be worth anything when the recipients receive them, but the bills will be paid. That's what he said. So you had a senator admitting that Social Security recipients were going to receive worthless Social Security benefits. Imagine that. Yes, we're going to pay all the Social Security people with worthless money. But what Proxmire didn't point out, maybe it didn't dawn on him. If the Social Security benefits are worthless, then everybody's money is worthless, right? Because it's all the same money. So if you get a check for the government for Social Security and it's worthless, then everybody's bank account is worthless. Everybody's pension is worthless. Everybody's annuity is worthless. Everybody's cash value in their insurance policies. Everything is worthless. Everything is wiped out. It's not just the Social Security benefits that are wiped out. And this is what a sitting senator, the head of the Senate Committee on Money and Banking, admitted. And he was smart enough to know about that in the 1970s. Are any of these guys in Senate today? Maybe Rand Paul knows. I mean, how many know that we can make all the Social Security benefits worthless? That the government could use the printing press, because according to Neil Kashkari, they've been ordered to print, and there's no limit to how much they're going to print, right? It's a print fest by the trillions. They'd actually be dropping money from helicopters. The problem is the helicopters aren't big enough, and there's not enough of them. That's how much money that they're going to drop on this economy. What is going to happen to the value of that money? You don't want to find out with it. Again, it's a game of musical chairs. Get out before the music stops. Take a seat. I'm offering you a seat, a nice, comfortable seat, so you'll be sitting pretty while everybody else is broke. Hey, Peter, just got back from New Zealand, barely beat the quarantine. Ever consider doing a book signing in the tri-state area? I've done book signings. Of course, I'm not doing it now. That's like, New York is the corona capital of the country, coronavirus, and you got a lot of cases now. I haven't even been back to Connecticut. So, yeah, I'm hunkered down here in Puerto Rico. But yeah, I've done book signings. The problem is I don't have any new books out. I haven't written a book in years. I've been doing my podcasts and my YouTube videos instead. But I will make an I told you video at some point, a book, an I told you book. It's just been, it's too early to say I told you so, because I need to wait until everything comes true. And believe me, everything is going to come true. I'm 100% convinced that all my forecasts are going to come true. Unfortunately, I mean, it would be nice if I was wrong, but I'm not. I don't think so. And so far, everything that's happened over the last decade or two just reinforces that I'm right. I mean, all the stuff that's happened. Yeah, I knew this would happen. Yep, I expected this. Yep, all this stuff that people are like, oh my God, that's completely surprising the hell out of people. None of it surprises me. All that surprises me is it's taken so long. The things that I thought that were going to happen, that nobody else thought would happen, that are completely surprised that they're happening now. The only thing that surprised me is that it took this long for those things to happen. Peter, I think this is a Swedish kroner question. I don't know. Let me see. Peter, could the dollar milkshake theory go on forever? Approval would be the milkshake theories. No, I don't think it can go on forever. That's the bet I have, on the dollar going down with Brent Johnson. No, I think it can go on temporarily, but I don't think it's going to last very long because, we are the world's biggest debtor. America is the world's biggest debtor. We're printing the most money. I don't care that a lot of other countries borrow in dollars. No other country borrows more dollars than America. And we're broke. We can't afford to pay. And so we're going to keep printing dollars. And we run massive trade deficits. We are flooding the world with dollars. The world may need dollars now, but soon they're going to be awash in dollars. They're going to have all these dollars that nobody needs and that nobody wants. And the bottom is going to drop out and the dollar is going to crash. And it's going to crash hard and it's going to crash fast when it happens. Don't make sure that when you go to bed at night, you got your gold, you got your foreign assets. Because believe me, I think the dollar crash is going to start in our sleep because I think it's probably going to start in Asia. So people are going to go to bed wealthy and they're going to wake up broke. That's what's going to happen. Thanks for everything, Mr. Schiff. $10. If you had $500 cash saved, what would I do with it? Yeah, stock up. $500. You can go buy some silver at your local store, at your local coin store, pawn shop, or $500. That's all you have. Groceries. Fill up your cupboards, fill up your refrigerator. Hopefully, you don't have to wait online because if you don't have to wait online, you're going to have to wait online soon. Can I explain negative interest rates? Yes, I can. I can explain them. I mean, the central banks are holding interest rates artificially low, and they're holding them so low when the federal government, the central banks are buying up so much bonds and creating so much phony demand that the only way you can buy one, if for some reason you need one because you can't put money in, you can't have the cash, right? You're an institution and, you just can't take $10 million in cash and get it in, $100 bills, and the banks, you're worried about a bank. You don't want to put a bunch of money in a bank because the bank might fail. So you might figure, you know what? My best choice is just to lose a little bit of money buying a treasury bond with a negative interest rate. So you're just paying a small tax for a less likelihood of losing your money, right? So because you're going to risk losing money no matter what you do with it. If you take the cash, you risk losing it. Someone steals it. You don't know what to do with it. You put it in the bank can fail and you get a bail-in. So you go for negative interest rates. But I mean, this is all crazy. I mean, because nobody would actually, no individual, right? Nobody is going to buy a bond with a negative interest rate. You'd be a complete moron. Why would you do that? You don't lend money to somebody for 10 years to get back less than you loaned. Why just use the money yourself? Why loan it for less? The reason you don't consume today, the reason you defer your consumption, make a loan, is because you're going to get to consume more in the future because you're getting paid interest. If you're paying interest to the guy who's borrowing from you, and so you end up consuming less because you made the loan, there's no incentive to make that loan. So this is the insane world that we live in. And there's that old expression, who the gods will destroy, they first make mad. And that's kind of how you know that we are on the eve of our destruction, because we are clearly a nation gone mad. And, while I'm on that subject, before I get back to the questions, this reminds me of this $1 trillion coin idea that I meant to talk about earlier in this broadcast. But AOC and her crowd in the squad, they want to dust off the concept from the debt ceiling crisis. Of course, the crisis isn't the ceiling. That was the salvation. The crisis is the debt. The ceiling is what saves us from the debt. Yet they always claim we have to get rid of the ceiling because we have to pay our debt. No, the ceiling is what's supposed to make us pay our debt. We want to get rid of the ceiling so we can keep not paying our debt. That's why we have to keep raising the ceiling, because we keep not paying our debt. If we paid our debts, they wouldn't be going up and we wouldn't have to raise the ceiling. But the way they wanted to get around the ceiling is what they want to do now by minting $1 trillion coin. So people have asked me, what is this? What do you mean mint $1 trillion coin? First of all, why platinum? Why make it out of platinum? Why not gold? Well, the official price of gold is $42.22 an ounce. They can't mint a coin big enough to get $1 trillion gold coin without officially devaluing the dollar, which they don't want to do. So there is no set value of the dollar in platinum. So I guess they could just make it whatever they want. So they can officially set the price of platinum at $1 trillion an ounce, and they can print the 1 ounce coin. And now they have $1 trillion. The difference between that and the way they normally get money is the government borrows money from the Treasury. Now they can print up dollar bills. They can print ones, tens, and hundreds, but you can't go that far with that. So what they generally do is they want to spend stimulus money. They have to sell bonds into the market, and then the Federal Reserve ultimately buys those bonds off the primary dealers rather than the market, which they're doing now, and creates money out of thin air. And it's the money that's created out of thin air that the government can spend. But as money is being created out of thin air, the national debt is going up. And all that money is owed to the Fed, which holds all the government IOUs. Well, if you can mint the $1 trillion coin, then you don't have to do that. You just take the $1 trillion coin and then take it to the Fed like you would take a $100 bill to a bank and ask for change. So you basically go to the Fed with your $1 trillion coin and say, hey, I've got $1 trillion. I want to deposit this $1 trillion in your bank. I just like you to change it, please. And now give me ones, like give me cash in my account. So here's my $1 trillion coin. Give me $1 trillion that I can now use to pay people, because you can't pay the people with the coin. But if the coin is worth $1 trillion, then the Fed can take that $1 trillion coin on its balance sheet and create $1 trillion worth of IOUs that are now backed by $1 trillion coin instead of a government IOU. But the problem is when the Fed does that, they're actually insolvent, right? Because how much is that $1 trillion coin actually worth? Well, if it's an ounce of platinum, it's worth the market price of platinum. What is it? $1,200, $1,000? I mean, it's actually less than gold. So that's all they got. But the whole thing is a farce. It's a fraud. It's basically a way to allow the government to directly do what they're not supposed to do, what they're doing through the Fed, and which, of course, is completely unconstitutional, right? And the way the Fed is operating is unconstitutional, but nobody cares. But the idea is, hey, we'll just create these $1 trillion coins, and then we never have to have debt. We can just print as much money as we want, and we can give out as much money as we want. Yeah, they can print as much money as they want. They can mint $1 trillion coins until $1 trillion is what you need. I mean, pretty soon you'll need $1 trillion coin if you want. People have been pulling their money out and moving it over to Merrill Lynch and putting it in a money market account where they can earn about 5%, which of course makes sense. The banks can no longer attract deposits. How do you have banks where you can't have depositors? Because they can't afford to pay the depositors any interest because they're broke, because the banks have already loaned out all their money for 30 years to the US government or to American citizens. I've got a mortgage with that same bank. Bank of America has my Connecticut mortgage, and I'm paying 3.25%. And there's still more than 25 years left on that mortgage. They are eating it on that mortgage. They're losing a ton of money paying, only collecting 3.25%, right? And I warned about this as I had the mortgage, and as I was talking to people about this, and everybody was so excited about how great it was that everybody could refinance their mortgages. I just kept saying, it's great for the borrower. It's going to be a disaster
for the lender. And of course it is. And the Fed doesn't want to put any more pressure on the banks by raising rates even more. It doesn't want to put any more pressure on the commercial real estate market, which has a massive amount of pressure on it already. So the Fed is looking for a reason not to hike. And so, they probably come up with one. But the minute they do this, I think you're going to finally see a drop in the dollar, like the next leg down in the dollar, which is going to spark a move up in commodity prices. The stock market already rose on anticipation of a Fed pivot, but we haven't seen any of that in the gold market. Gold prices, they did spike about $20 on that weaker than expected jobs report, or not jobs report, unemployment number that came out on Thursday. But we're still just treading sideways. We're holding below 20,000, 1,960. But we haven't seen an explosive move up. We haven't seen a big breakout in other commodities, oil, nothing. It's just been the stock market that has basically been the big mover, moving on anticipation of the change in monetary policy, moving from a tightening cycle to an easing cycle. But I think if the Fed doesn't hike next week, that could be the catalyst to get the dollar to resume the bear market or enter a bear market, get gold to break out and into new highs well above 2,000 and continue to move. And I think that is going to start to put a lot of upward pressure on consumer prices. I've been saying I think we're near the trough in year-over-year CPI, and I think we are. The last couple of CPI numbers have been worse than expected, meaning higher increases month over month, year over year. So we've kind of bottomed out at around this 5%. I mean, miles away, not even close to 2%. And then we're going to start heading up. And here's going to be the problem for the Fed. As inflation starts to pick up after they've already paused and as the economy is weakening, and especially if they've started to cut, right? So, because they may start to cut rates before the inflation numbers really start to get bad. But if they're not really bad before that first rate cut, they're going to get bad after it. And I think all this is probably going to happen, before the 2024 election. I'm going to talk a little bit more about that after I finish talking about this, because there's a lot of political news that has just come out, and I want to get to that. But I think that rather than the Fed fighting inflation, it's going to be the government that tries to fight inflation, but not in any way that's going to work. I think they're going to impose price controls. And that's already happening right now in France. I've been reading these news stories. In fact, I tweeted about one today that the French government has basically forced French supermarkets, right? So right now it's just in the food sector. And maybe it's going to spread to other segments of the economy. But the French government is applying financial pressure to the supermarkets, grocery stores, not only to stop raising prices, but to actually cut them. And I think prices are going to be cut maybe 2 to 8%, something like that, on all these different food items. Now, this is not the reason that there's an inflation problem in France. It's not because the grocery stores are gouging the people. It's because the European Central Bank gouged the people with money printing. That is why prices are going up. Christine Lagarde, Mario Draghi, particularly Draghi, because he was there for a lot longer, he kept saying that the problem in the Eurozone was that there wasn't enough inflation. His main goal as the head of the ECB was higher inflation. Well, he succeeded. The goal of the European Central Bank was for the cost of living to go up more because it wasn't rising enough, and that would include food. So the fact that food is more expensive is the consequence of a deliberate effort by the European Central Bank to increase prices. right? Well, they succeeded. And also, all of the budget deficits that are being run by the European governments, including the French government, which the ECB has been monetizing. So these supermarkets, they're not causing the inflation. They are responding to it. They are victims of it. In fact, many of these companies, and I own stock in quite a few of them, but a lot of these companies, even though they raised their prices, they didn't raise them enough. Their costs went up more. And the French politicians are now saying, hey, look, your input costs have been going down. Why aren't you cutting prices? Well, the reason is because they didn't raise them enough when the import costs were rising. In fact, initially, as costs started to go up, a lot of these companies were reluctant to raise prices. They thought it might be transitory. They didn't want to risk alienating their customers. And so they were behind the curve. And so now that some of the raw material costs are going down, you can't say, oh, we're going to immediately start cutting prices if we haven't even raised them enough based on how much their input cost already rose. But no, right? The politicians weren't, mad at the supermarkets for not raising their prices when their costs went up. But now they're pissed off that they're not cutting them when their costs went down, even though they probably still haven't raised their prices enough to keep up with their costs. Their margins have suffered. I know that as a shareholder. But what I've been expecting is for the companies to eventually catch up by pushing on, more price hikes. But now that's difficult, at least in France, because the French government is not allowing this to happen. And so this is going to have broad ramifications in France. The one thing it's not going to do is produce lower food prices, because what's going to happen is these grocery stores, supermarkets are going to have to figure out other ways to make up for this loss. And so the customer is going to feel it one way or another. They're going to find ways to reduce the quality, or they're going to come out with new cuts of meat that they can put a price on that won't be a price hike because it's a different product. They're going to repackage stuff. I mean, things are going to happen. Or, there's just going to be less supply. And maybe you're going to go to the supermarket and there's just not going to be enough stuff there. Maybe some of the items that these supermarkets are not allowed to price correctly, well, they'll just stop stocking those items. So they're not going to raise prices because they're not going to have the products anymore. And so that will have accomplished the goal of the French government. Prices won't be going up, but it won't matter because there'll be nothing to buy because the stuff won't be there on the shelf. So now the supermarket can say, yes, we didn't raise our prices because we no longer stock those items because we can't sell them profitably without the politicians, sanctioning us. But the reason I'm bringing up what's going on in France is because I think that's coming to a theater near us pretty soon, because that's basically all they're going to have. When the price increases start to accelerate after the Fed has cut rates, right? What are they going to do? The Fed can't reverse and start hiking rates if it's just started cutting them. And so if the Fed is powerless to do anything about the resurgent inflation, that's going to leave it to Congress, to the president, who might do it by executive order. And what could he do by executive order? Well, I guess price controls. That's what I think Biden is going to do, especially if he's looking bad in the polls. If inflation is a big issue, how is he going to do anything about it? Well, he's going to try to order companies to stop hiking prices or reduce prices, just like France is doing it right now. And that may be the only way to help his chances of being reelected.
Pain. Now it's going to be excruciating. We can't delay it anymore, right? We've now caught up to the can, and it's now so enormous that we can't kick it anymore. Getting back to what I said, if we had done the right thing and let businesses fail and let interest rates rise and replenished our savings and developed a viable economy that was self-sufficient in savings and production, right? Like it used to be when it really was a great economy. But instead, we inflated the biggest bubble that the world has ever seen, completely dependent on debt and consumption. And now that bubble is blown to smithereens. And we're going to have to deal with the consequences. The piper has been playing for decades. And the irony of it is he may want to be paid, but all we have is worthless currency to pay him in. So I think now this is like an official game of musical chairs. And you got to get out of the dollar. Not only the US dollar, not only US treasuries, but all US dollar denominated debt, because all of it is going to get bought up by the Fed, because any debt the Fed doesn't buy is going to soar in yield and collapse in price. And so that's why I think that long-term interest rates are not already soaring. It's because the Fed is in there buying, because only the Fed would be dumb enough to buy US treasuries. In fact, it's not about dumb enough, it's desperate and insane enough. And the reason they're buying is because they create the money out of thin air. So what do they give a damn what it's worth? But obviously, people who are expecting to retire or live off of the income that those bonds produce, you'd have to be a fool to buy them. In fact, right now, as I said, it's musical chairs. When the music stops, if you still have any dollars, if you still have any treasuries, muni bonds, corporate bonds, cash value left in your annuity, in your life insurance, a fixed annuity, if you have any of that stuff, when the music stops, you lose. And you don't just lose a game, you lose everything. And so you gotta make sure that you're sitting down before that music stops. And the obvious chair is gold, right? You gotta have gold. It's up over $50 an ounce today. You know, it's a good thing that there's so much ignorance out there in the financial media, because if people on CNBC or Fox or CNN or any of these networks, if they had one person on there leveling with the American public like I am, and actually telling people what's going to happen and explaining the mistakes that the Fed and Congress not only made in the past, but is making now. And if you don't know by now, if you can't see how many of my predictions have come true, things that nobody else predicted but me, at least publicly, all this stuff is happening. Things that nobody could have even imagined. People thought I was crazy when I talked about this stuff a decade ago, and it's all happening now. And some people are just focused on, well, the stock market is still up. Well, the dollar hasn't crashed. You know, gold's only 1,600. If you wait until all of my financial predictions come true, just like all of my economic predictions and Fed predictions have been coming true one after another, well, then it doesn't matter. I mean, you can't help yourself. You're broke. But you still have the opportunity to recognize the truth of what I've been saying and the folly of what everybody has been saying in the conventional media, and recognize that these fools on Capitol Hill who are so convinced that what the markets need is another bailout. They don't need another bailout. We need a bailout from the bailouts, but the only bailout will work is the free market. We need capitalism to bail out the economy from failed socialism. Unfortunately, we're about to elect Joe Biden. And even though he's not Bernie Sanders, he's going to govern like Bernie Sanders. He's going to be pushed to the left by the biggest economic crisis in U.S. history. Said, if you think the Great Depression was bad, you don't know anything about how bad this is going to be. Maybe so much worse. I said earlier on that during the Depression, the cost of living went down. This time, the cost of living is going to go sky high. You want to know what it's like when your money collapses in value? Take a look at some of the YouTube videos of Venezuela. You know, it's not pretty. You know, yeah, they're going to try to blame it on the coronavirus. Don't believe anybody. In fact, this is probably the best news the government has had. This is the best scapegoat they could have hoped for. Oh, the coronavirus, right? This couldn't possibly be our fault. Oh, this is another 100-year flood, which we seem to have every 10 years or so. But, oh, this is totally out of left field. Nobody could have predicted this. Look, bad things happen. That's easy to predict. Exactly what? Nobody really knows. But it's going to rain. It's not always going to be sunny, and sometimes when it rains, it pours. That's why you save for a rainy day. You don't pretend that it's never going to rain and leverage yourself up to the hilt, but that's what we did as a nation, because nobody wanted to pay the cost of saving for a rainy day, because you can't spend and save the same money. If you want to build a real economy, you got to stop spending. But if you have a phony economy based on spending, if you stop spending and start saving, then the phony economy implodes, which is exactly what you want a phony economy to do. Because the sooner it implodes, the better. Because the longer you prop it up, the worse it's going to be. And we've succeeded in propping it up for so many years longer than anybody could have thought, who understood the actual nature of the problem. So now it's going to collapse in a more spectacular way than even I imagined. So the economic outcome is going to be far worse than I thought when I was writing Crash Proof in 2007. I'm not happy about that. I really wish that cooler heads would have prevailed, and that, you know, the Austrian school and people like me and others. And again, I'm not the only one. Right? I don't want to act like I'm the only one that saw this coming. I just saw it coming and explained it in a more public way than a lot of other people. And it's not that I'm so smart. I mean, it's just that everybody else is so dumb. I mean, that's the reality. I mean, you don't have to be a genius to figure this out. You just have to be a complete fool, right, to miss it. Or you're just caught up in the moment. You know, that is the problem with bubbles, right? When you are trapped in a bubble, and there are a lot of smart people who have been in this bubble for a long time. And the problem is they don't know it, right? It's like that movie, The Truman Show, right? They think it's reality. They don't know it's fantasy. But I'm not inside the bubble. I've always been kind of on the fringes. And I've been able to look at everything objectively from the outside. And from the outside, you see the bubble, right? But nobody that's in it, they're all in it together, they have no idea. And so that's why, you know, it still hasn't dawned on them that they made mistakes in 2008. They still think it worked. That's the crazy part about it. It didn't work. If it worked, they wouldn't have to do it again. Think about how much quantitative easing, the trillions and trillions and trillions that have already been committed. You know, I said this. I said that QE4, if we're going to count this as QE4 instead of 5, 6, 7, and 8. I mean, they've announced it. They announced a brand new QE program every day now. So I don't know if we just lump it all into one big QE or just keep on with the numbers, because we're already way through the Rocky movies. But why did I say from the beginning that QE4 would be bigger than QE1, 2, and 3 combined? Because I knew that in order to try to inflate a bubble bigger than the bubble in everything that popped, they would need the most monetary stimulus ever. But I said it's not going to work. It is impossible. You cannot blow up a bubble that was bigger than the one we just had. And the reason these clowns think it worked is because the stock market made new highs. Real estate prices went up. So what? The stock market was overvalued. Even in 2008, it was overvalued. Making it more overvalued was a mistake. The real estate market was even more overvalued than the stock market. And instead of letting real estate prices keep falling, which was part of the cure, we made the economy sicker by pushing them back up again. And the reason we had the weakest recovery, but the longest lasting recovery ever, is because we didn't recover from anything. We actually got sicker the entire time they told us the economy was recovering. That's why Donald Trump got elected, because he leveled with the public about how bad the economy was and how the numbers were phony. The problem was, after he became elected, he conned the public with the same phony numbers and tried to get everybody to believe that the economy was great. And he was able to increase the illusion with deficits, with tax cut finance deficits. So he was able to blow extra air into the bubble to increase the delusion and get corporate America on board, get the Republicans on board to actually think that he had made America great again, instead of taking the bubble that he inherited from Obama, which Obama inherited from Bush, which Bush inherited from Clinton, right? We just made all those bubbles bigger. That's all we did. We continued the bubble blowing. Well, the bubble blowing stops now. This is it. And the Fed is going to destroy the dollar this time. The inflation is not going into the financial markets, right? That's why the stock market is not even really responding to the Fed stimulus. Yes, I think the market would likely be lower without all this money printing, and we may even get some kind of BS rally at some point. But gold is what's going up. The only thing is the dollar is
generating all this spending. And because our economy is stronger than, let's say, the Japanese economy or the European economy or the Chinese economy, we're running a trade deficit. Our economy is so strong, we're spending so much more than everybody else. Of course, that is pure nonsense. We don't have a trade deficit because we have a strong economy. We have a trade deficit because we have a weak economy. You know, once upon a time, America had the strongest economy in the world, and we had the biggest trade surpluses in the world at the same time. You see, when your economy is strong, you produce a lot of stuff. You produce more stuff than you need, and you export the surplus. So strong economies are productive economies. They produce excess stuff, more than they need. See, we're trying to redefine strength as spending. Spending money is not a sign of strength. In fact, it could be a sign of weakness if you're borrowing that money, which is exactly what we're doing. You know, other countries are saving while we're going into debt. Those are the strong economies, not America. It's the countries that are operating with trade surpluses, that produce more than they consume. Those are the strong economies. It's a weak economy that consumes more than it produces. It's an economy that is made up of people who are living beyond their means. Is that what you do when you're strong? Do you live beyond your means? No. When you're strong, you have so much means that you can live beneath them, that you can accumulate savings. That's how you accumulate wealth. So even when they report on the trade deficit, they misreport. They don't understand it. And again, I think it's because so many people are of the mindset that America has a strong economy, that they take this weak economic data and they somehow try to sugarcoat it, or their mind just can't comprehend that it's evidence of weakness. So people take this weak economic data and they spin it as if it was strong. And a lot of people just, oh yeah, sure, we have a strong economy, so we go out and spend. Right? These other countries, they don't have all that economic strength, so they can't spend so much. And maybe superficially, if you don't really have much of an understanding of economics, you know, you could buy this. And unfortunately, most of the people who are economists in this country, who teach economics or who are professionals that work for the government or the Federal Reserve, they don't understand anything about economics either. So they might think that these trade deficits are a reflection of how strong our economy is, but the reality is it's the reverse. But what's more significant right now about the trade deficits is that it has to be financed. And we have $2 trillion budget deficits. Nobody talks about the twin deficits anymore. They were a huge problem in the 1980s. Everybody talked about the twin deficits back then because we were running trade surplus, trade deficits, and budget deficits. And they were a problem. They were a big problem for the bond market. They were a big problem for the dollar. And they became a big problem for the stock market. In fact, the trade deficits and the impact it had on the dollar and the bond market is probably the real reason that we had the stock market crash in 1987. But today, nobody cares about either of these deficits, even though they're both much bigger now than they were back then. Well, nobody cares until they care. And I think soon people are going to start paying attention to these numbers. And again, what I think we saw in the markets this week, and especially on Friday, given the failure of the bond market to rally on a weak jobs number, right? Given the fact that the dollar and the bond market decoupled, where the dollar sold off and bonds sold off, or coupled, because they had been trading opposite, right? Because they were all trading rate. The currency traders were looking at strong economic data, which was bad for bonds. They were buying the dollar. So even though they were selling treasuries, they were buying dollars. Now they're selling treasuries and dollars at the same time. That is a very bad sign for the U.S. economy and for the financial markets. And again, gold went up and oil went up. And oil went up, you know, a couple of bucks, but on a chart, we've now taken out some resistance. There was, you know, oil was trading below 70 for a while, and now it's kind of broken out. And so it looks like there's a lot of room to go up. And if oil prices are going to rise, a lot of other commodity prices are going to rise too. And the main reason that we got the break in the headline CPI was energy prices and other commodity prices that came down. If they're now going up, if oil has bottomed and we're going up from here, that's going to start to put the upward pressure on these official inflation numbers. And remember, the whole time headline inflation was coming down, the core wasn't. I mean, the core numbers still stayed in the high fours, low fives. Never got anywhere near 2%. Because again, remember, the Fed is more focused on the core, not the headline numbers. And so we got more relief in the headline numbers than the core. But now the headline numbers are going to turn higher. And the core never really went down. And now that's going to turn higher. So this is a huge problem, because if the markets recognize that inflation is here to stay, that is a whole new ball game for gold and the dollar. And I think this is a great time, to be buying here. Gold is not breaking 1900. I mean, it closed the week around 1925. I really haven't seen it trade below 1900. So it's in a very narrow range. Yes, it didn't hold 2000. And so a lot of people got bearish on gold because it didn't hold 2000. So what? It's holding 1900. Gold is holding up despite the fact that everybody is optimistic on the economy, optimistic on tech, optimistic that the Fed has gotten the inflation genie back in the bottle. There's all sorts of optimism out there and very little interest in the price of gold or buying gold. And despite all that, gold hasn't gone down. And I think it's holding up a lot better than people give it credit for. And we're getting ready for a big move up. So I think, this is a good time to be buying at this price. I don't think you're going to get much lower prices. If you're trying to wait for a low price, I think you're pretty much in the neighborhood of the bottom. And so this is where you should be buying your gold, more, even your silver, even more so. I see more upside in silver than gold, but I see upside in both of those metals. So again, you want to contact Schiff Gold and buy some physical gold and silver. For those of you who are risk takers, right? If you want to try to make 5 or 10 times your money or maybe more, the way to do that is not in physical gold, but in the mining stocks. If the price of gold does what I think it's going to do, then we're going to have an explosive rally in these mining stocks. And nobody is buying these stocks. I mean, the sentiment is very negative in the sector. People are still chasing the tech names or now the AI names, but nobody is paying attention to the real inflation trade. Nobody is buying the senior miners, let alone these junior miners. That's what you should be doing. Right? You need to be looking at where the big money is ignoring. Right? That's how you end up making a lot of money as a speculator. You got to figure out what the crowd is missing. And then you got to get to where the crowd is going to ultimately be before they arrive. I know eventually the markets are going to figure out what I know. They're going to come to terms with the reality of higher inflation. It's going to be reflected in the bond market. It's going to be reflected in the gold market, the dollar, and it's ultimately going to show up in the price of mining stocks. So the crowd is going to figure this out eventually. And when they do, it's going to be a stampede, right? And they're all going to be, running into one another, bidding up these prices. There aren't a lot of mining stocks out there. Even if you added up all the market caps of the whole sector, you don't even get one decent S&P 500 company. I forget the combined market cap of all the gold stocks, but it's very small. And even if the institutions that are out there, the pension funds, the endowments, the hedge funds, if they just want 5% allocation to this sector, it's a game changer. Probably even 2%, 1% would be huge, because right now it's practically zero. So there's really no interest, even though there should be tremendous interest, because again, we still have faith in the Fed. People still believe Jerome Powell. They believe, everybody else on the FOMC. When they say they're going to bring inflation down to 2%, they believe them. They still don't get that they're going to say that regardless of what they're actually capable of doing. But the other way you know that Powell is not serious about bringing inflation down to 2% is that he's saying nothing about the budget deficits. He's not telling Congress to cut government spending, because there's no way that inflation is coming down to 2% unless that happens. And Powell has got to know that. His job is impossible with $2 trillion budget deficits and $1 trillion trade deficits. There's no way. Inflation rates are headed much higher unless we have massive cuts in government spending. And that's not going to happen. And it's especially not going to happen if you have a weak Fed chairman like Jerome Powell, who is afraid to speak up and tell Congress what they need to do and what they need to hear, and that they've got to reduce spending significantly. They're still spending, like it's COVID. We had this huge increase in government spending during COVID, and while it's come down quite a bit from the extreme levels that we got to, they didn't return to the levels pre-COVID, and they were extreme too. We were spending too much before COVID. Now we're even spending that much more
to come close to making up for what they've lost from their paychecks. But what those unemployment benefits will do is fuel the fires of inflation.
Peter said there is something the markets haven't figured out. They still think the central bank will succeed in its fight against inflation. They believe if the rate hikes don't do the trick, the recession will. According to him, the markets think inflation is going away. But the markets are wrong on both fronts. These rate hikes are not going to be sufficient to get rid of inflation. We still have negative interest rates, and the Fed isn't even going to come close to getting rates to neutral, let alone positive real rates that would be required to actually fight inflation. And at some point, the economy is going to be so weak that FOMC members are not going to be able to pretend that it's strong. They're not going to be able to shrug off all the evidence of a severe recession. And we are going to get to pivot. As far as the unemployment number goes, it's important to remember that the government doesn't count all the unemployed people as unemployed. For the official headline unemployment statistic, the government uses a number known as U3. Another number, U6, includes underemployed people, those who are working part-time but are looking for full-time employment. Think of the guy delivering pizzas because he can't find a job in his field. Discouraged workers who have given up looking are also included in U6 for a year. After a year, those people fall out of U6 as well. Peter said if you included all of those people in the unemployment number, and at one time they did, the rate would likely be over 10%. In this video, Peter goes on to note that the Fed has abandoned inflation averaging, unemployment and rate, and weak labor market, and he also talks about the record levels of household debt. He also discusses the collapse in real wages, the impact of the recession on average poor people, and why you should act fast before things get worse.
The labor force continues to shrink. Another 186,000 people left the labor force in November. And in fact, the number of working age people who are no longer in the labor force rose by 359,000 in November. And we're now back over 100 million Americans who could be working who aren't. So the bitter irony of the November jobs report is that we didn't create 260,000 jobs because the economy is strong. We created those jobs because the economy is weak. And these new jobs don't indicate a strong labor market. They indicate a weak labor market. Why were these jobs created? Because people who already had jobs couldn't afford to pay the bills with the jobs they had. their wages were falling in real terms, and so they needed another job to make up the loss. And so they took a second job or they took a third job. This is not unemployed people returning to work. This is people who are already working being forced to work harder, being forced to take multiple jobs and spend more of their time working and have less time for leisure, less time with their families. This is not strength. This is weakness. In a strong labor market, you only need one job. In a weak labor market where wages are falling, that's when you need multiple jobs. And of course, if we really had a strong labor market, workers would be able to demand wage increases above the rate of inflation. In other words, workers could demand to get paid more money rather than being forced to keep working for less money. And instead of being able to negotiate a real pay raise from their employer, being forced to seek second and third employers because that's the only way they can make ends meet in a weak economy with a weak labor market. But this weak labor market is going to get much weaker in 2023 as the layoffs really begin to mount because they're only just getting started. And what's going to be particularly problematic about this recession as the unemployment rate really starts to spike is that the unemployed workers are going to be in extremely dire financial circumstances. In fact, if you look at the numbers that came out yesterday on personal income and spending, personal incomes rose by 0.7% and personal spending rose by 0.8%. But again, these are unadjusted relative to inflation. In real terms, personal income and spending are falling. But what's significant about the numbers is that once again, spending outpaced incomes, and that caused the savings rate to fall to 2.3%. This is the lowest the savings rate has been since July of 2005. And of course, in July of 2005, the reason Americans weren't saving is because they were so flush with home equity. Everybody thought they were rich because that was the peak of the housing bubble. And so people weren't saving, they were splurging. They had no idea that a great recession and financial crisis was just a few years away.
Peter emphasized that the risk everybody is worried about is the wrong risk. It's not that the Fed is going to raise rates too much. It's that they're not going to raise them enough. It's that they're going to pivot too quickly. It's not that the Fed is going to mistakenly believe that the economy is strong and then overestimate how high inflation will be. It's the weak economy that's going to cause inflation to be higher. Because as the economy weakens, production will decline, but money printing will expand. In fact, at some point, the Fed will pivot in response to a much weaker economy than it expected, and that's when the dollar is going to tank, and that's when consumer prices are going to take off.
But fast forward to 2022, when we are just entering a recession where millions of Americans are about to lose their jobs, they have no savings to fall back on. And not only do they have no savings, but they already have record credit card debt. Credit card debt right now is at an all-time record high. So Americans are about to lose their jobs with no savings and maxed out on their credit cards. But making the situation even worse is that homeowners are about to lose their home equity because real estate prices are about to drop sharply given both the surge in mortgage interest rates and now the coming surge in unemployment and recession. Very few people are going to be able to be in a position where they can afford to buy a house. And so the only way anybody who owns a house will be able to sell it is if they do it at a much lower price. But all of those transactions at lower prices wipe out everybody's home equity.
Peter said the inflation that we're experiencing now will kick into a much higher gear during the next economic downturn. Everybody just assumes that when the economy weakens, so too will inflation. No. The weakening economy is going to strengthen inflation because inflation is the expansion of the money supply. And the weaker the economy gets, the more the Fed is going to expand the money supply to try to stimulate it. And as the return of quantitative easing causes a mass exodus out of the US dollar from foreign central banks and private holders, then the falling dollar is going to push consumer prices up dramatically.
Because where is the government going to get the money to pay all these unemployed workers benefits? Going to be printed. The Fed's going to create this money, which is why I am still convinced that by 2023, the Fed helicopters are going to be back in full flight. Quantitative tightening is going to be a thing of the past, and a brand new QE program is going to be launched, but it's going to be launched with high inflation, not low inflation. The Fed's going to pivot, even though it's not even close to its 2% inflation objective. And why is the Fed going to pivot? Because the recession that we are already in is going to get much worse. In fact, it may even morph into a financial crisis, and the Fed will be forced to abandon its inflation fight in order to fight what it believes to be an even larger threat in the economy. But the negative consequences of the higher inflation will play out later in time than would the consequences of continuing to fight inflation in the face of a massive recession.
The weakening dollar will also cause the trade deficit to widen, putting downward pressure on GDP and creating a self-perpetuating spiral of inflation and economic weakness. According to Peter, this is going to be the worst.
Who's left to buy? Nobody. Everybody's already bought. You just got a bunch of people who are looking to profit from the halving who want to sell. And in fact, as I expected, as I said on my last podcast, that they may not have bought the rumor, sell the fact. They might have sold on the rumor of the fact. And that's exactly what they did, because even though the halving didn't happen until today, Tuesday, the real break, I think, in Bitcoin was on over the weekend, was a Saturday or Sunday. And all of a sudden, Bitcoin in about, 5 minutes fell almost 2,000. It went from about 10,000 down to almost 8,000 in just 5 minutes, 10 minutes, collapsed. It immediately bounced back to around 9,000. As I'm recording this now, it's 88 and change. But we got that big sell-off leading up to the halving. And of course, by the time the halving happened today, it was a yawn. It had no impact on the price. But we did get a big sell-off leading up to the halving, because I think the people who were speculating were worried if they waited for the halving itself, the price might have dropped. And so they front ran the halving, and they decided to sell in advance, which is something I thought might have happened. And I talked about it on the last podcast, and that's exactly what did happen. But now I think you still have a lot of guys who bought in front of the halving, who were intending on selling at a higher price after the halving, and may have to settle for whatever price they can get. I think a lot of disappointed Bitcoin speculators are going to be selling, and there's another leg down. That initial 2,000 point dollar drop was the beginning of a bigger move. We barely got above 10,000. I mean, we got to like 10,100. There's so much resistance up there. Even with all the hype of the halving, we couldn't even really sustain a move above 10,000 going into the halving. We got that big sell-off. Now, we did get yesterday the Paul Tudor Jones interview on CNBC, which I thought was another catalyst to make Bitcoin go up, and that maybe if he was not positive on Bitcoin, it would end up being a negative. And what happened was the Bitcoin rallied sharply. It started a few hours before Tudor Jones was going to be on CNBC. And I watched the rally. It was a sharp rally. And as soon as Paul Tudor Jones started to talk, that's when the rally peaked. The absolute price of Bitcoin, it was over 9,000. Forget where it was, 91, 9,200. But it peaked just in the middle or as he started to talk. And it sold off as he was talking. And by the time he finished, about half the gain had been gone. So it was clear that a lot of Bitcoin people were trying to trade Paul Tudor Jones. They knew he was going to come on. They expected him to talk positively about Bitcoin. And so they wanted to use it as a trading opportunity to buy the rumor of John Paul Tudor Jones and sell the fact as he spoke. And that's exactly what happened. And you can actually see that trade play out in real time, just perfectly. But I think it really was just, a symbol of what's happening on a broader scale with the halving. It's a much bigger buy the rumor, sell the fact.
And so it's not playing out in as short a time span. It will take place over a longer period of time. But just to talk a little bit about what Paul Tudor Jones said, because he didn't give a glowing endorsement of Bitcoin by any means. He did admit that he thinks he has 1% of his portfolio in Bitcoin, and he thinks it could be a little more, that it's no more than 2%. It might only be 1%, but he's not really sure, right? He didn't know exactly. But clearly, if he's only putting 1 to 2% of his portfolio in it, he regards it as extremely speculative, right? I don't know what percent of Paul Tudor Jones' portfolio is gold, but I'd be willing to bet it's at least 10 times as high as his Bitcoin allocation. And I think the reason that he's keeping the allocation so low is because he realizes there's very good probability that Bitcoin's going down and he's going to end up losing money on that position. And so he wants to lose money on a small position because you can overcome that. Now, he did leave the window open, the possibility that Bitcoin could be his best performing asset, that in this environment of massive inflation and money printing, that Bitcoin really could take off. And since he's so confident there's going to be inflation and a rush into gold, and I agree with him on that, he just thinks that Bitcoin might be the fastest horse in the race. And so why not bet a little money on gold, on Bitcoin? Because if gold goes up because of inflation, maybe Bitcoin will go up a whole lot more. So let me throw 1% of my portfolio into Bitcoin just in case. That's, I think, the position he took, which is not a big position, because after all, most of the people who own Bitcoin today, the vast majority, probably have a lot more than 1% of their net worth in Bitcoin. I mean, I would say that most of these Bitcoin fanatics, their entire net worth, it could be in Bitcoin. I know that guy, Anthony Pompliano, I get into some wars with him on Twitter once in a while, otherwise known as Pomp. You know, he's talked about the fact that half of his net worth, and I think he's got a pretty decent net worth, but half of it is in Bitcoin, right? Well, you got all these Bitcoiners that are so excited about Paul Tudor Jones saying people should buy Bitcoin. Yes, with 1% of their portfolio. So if you've got 50% of your portfolio in Bitcoin, you're not following Paul advice, Paul Tudor Jones advice. Can you imagine if all the Bitcoin holders decided to follow Tudor Jones advice? Right? Imagine, right? They'd have to sell 90% of their Bitcoin, right? There would be a crash in the Bitcoin market. If everybody who owns Bitcoin went to follow that advice, the market would crash. Now, I know people are going to say, well, but what if everybody else in the world just decides to follow Tudor Jones and put 1% of their net worth in? If that happens, then, well, I'm going to make a fortune keeping half of my net worth in there, which is true. But the odds of that actually happening are very slim. That's why that's a 1% allocation. Because if you lose 1% of your portfolio and you're a good trader and you're making money on other things, and I'm sure Jones is going to make a lot of money on his gold positions, whatever they may be, and maybe he's got some gold stocks. I think he'll make so much money there. Blowing 1% on a Bitcoin gamble is going to be no big deal. But if you've got half your net worth in Bitcoin and you lose that, you may not recover, especially if you're one of these Bitcoiners that thinks gold is obsolete now and you own no gold, you own no silver, you've gone all in on Bitcoin. There's no way that Jones is going to do something like that, right? He's absolutely. So to say that, hey, this is the reason you should buy Bitcoin because now a hedge fund manager who is speculating on inflation. First of all, Paul Tudor Jones is in the minority, right, of people who are looking for stagflation, right, that kind of agree with me, right? There's a handful of us out there in the economics, and there's some people, you got Ray Dalio who says a lot of the same things that I do. So there's other big fund managers that are seeing stagflation, but there's not that many that even are worried about it. And if most of the people who aren't even worried about inflation now and who see no reason to get out of the dollar, if they become worried about inflation for the first time and they really want to seek out exposure, a hedge, something like gold. What's the odds, right, that are they going to go for gold or are they going to go for Bitcoin? If they don't own anything right now and they're managing institutional money, they're conservative by nature, they move slowly, and all of a sudden for the first time, they're worried and they want to hedge. Are they going to pick something like gold that has real intrinsic value, that's been a store of value for thousands of years, or a cryptocurrency that's 10 years old and they have no idea what it's ever going to be worth because it has no current intrinsic value? Are they going to gamble on Bitcoin or are they going to play it safe with gold, right? Obviously, gold is their next move. I mean, Jones already has a bunch of gold. He already has probably a bunch of gold stocks. All right, I'm going to take a flyer on Bitcoin. And who knows how long he's going to be in this Bitcoin position. Once this thing really starts to fall, he might cut his losses. He might get out when he's down 20, 30%. He may not ride the thing all the way down to zero. So who knows how long he's going to be there. But just because he may have a position now, this is not some big endorsement. This is one guy who's in the fringe kind of the hedge fund world acknowledging that he's doing something extremely speculative by taking a flyer on Bitcoin, but he has a feeling that it's going to work out because he thinks that we're going to have all this inflation and gold's going to go up, and so people are going to be looking for inflation hedges. I think he's wrong. And I heard people tell me, hey, Peter, look, it's just 1%. Why don't you put 1% of your net worth in Bitcoin? And, I'd rather put another 1% in junior mining stocks. I mean, if I'm going to take a big gamble, because that's what Paul Tudor Jones said. He thought that the upside in Bitcoin was greater than the upside in gold. So he thought there was more potential. Now, I don't think he appreciates the downside risk. I mean, he does. But I think if you weigh the upside potential relative to the risk, I don't think Bitcoin is a better risk-reward dynamic. Now, maybe if you think the upside potential is 1 million or something crazy like that, then you may come to that conclusion. I just don't think there's that much upside relative to all the downside. Yes, could Bitcoin end up going up more than gold for a period of time? It could, but I don't think it's worth the gamble that it might, when I think the odds are that it won't. But getting back to these, the mainstream guys, so are they going to take a chance? I mean, even Jones admitted on the CNBC interview that gold has a long history and a long track record, and it's proven. And Bitcoin is the new kid on the block. It's very risky. It's unproven. And so even the guy that owns both, right, has very different views of gold versus Bitcoin. One is a conservative store of value, and one is a flyer, right, that he's taking a shot on. As more people in the mainstream finally decide that they got a hedge and there's inflation, they're going to choose gold. They're not going to go from nothing to Bitcoin, right? They're going to go to gold before they potentially take a shot at Bitcoin, and then only with a small amount of money. But of course, if Bitcoin has already collapsed by then far fewer investors are going to be pressured to go in it. Because I think right now, when people see the big gains, hey, why did you miss out on that? Why didn't you get in? But once Bitcoin really starts to fall, then it's the people who got in that feel like idiots, and the people who avoided it can look like the heroes because they didn't fall for it. And that's when you get the real big PR problem for Bitcoin, right? When you have all these horror stories, not a bunch of get-rich stories where high school kids took their bar mitzvah money and became millionaires because they bought Bitcoin. Then you're going to hear stories about people who went broke buying Bitcoin because they invested a lot more than bar mitzvah money, right? They took their house money, they borrowed money and bought in at Bitcoin at a much, much higher price. They got in at the end of the bubble, or as the bubble was deflating, rather than early on, right, before much air even got into it. And so once Bitcoin has that really negative PR problem, it can't shake it, and then that's it. Then the party is over. But anyway, we're again 8,800 and change now. We'll see what happens tomorrow. Ben Bernanke is talking, so the markets are probably not Ben. Tomorrow, Jay Powell is talking. We had a few other Fed guys out today, but of course, none of them have the status as the chairman himself. So the markets are really going to be looking to what he has to say, potentially about negative rates. I am still looking for a big break in the dollar. I haven't had it yet. Still looking for a big move up in the price of gold. I think it's getting ready to happen. Hasn't happened yet, But I think it is going to happen any day. But anyway, I will be back again with another one or two podcasts later in the week as the markets develop. Again, we went off on a very, very weak note for the stock market. So I think we could be in for some interesting action in all the markets in the days and weeks ahead. Bye-bye. Activity index for February. Now, the January index was at 23, and the expectation was for a slight decline to, it was 0.23, excuse me, forgot a decimal point. So January's number was 0.23. The expectation was for a decline to 0.18 in February. Instead, we dropped all the way down to minus 0.19, so the opposite side of zero. So weak economy. The 3-month moving average, though, I guess, moved up a bit from minus 0.26 to minus 0.13. But the data was still worse than expected, and it does show a contracting economy. And that was before this financial crisis started, right? This is all rearview mirror stuff. This financial crisis didn't kick off until March. So none of this is in the February data, which was already bad. Same thing with new home sales. New home sales were originally reported for January at 670,000. These are annualized numbers. That got revised all the way down to 633,000. That's a big downward revision. And then even after that downward revision, the February number was still weaker than expected, although not by much. They were looking for 645,000, and we got 640,000. But I would expect that even though mortgage rates may have come down a bit in this crisis, I think that this is going to send an even deeper chill throughout the housing market. Because a lot of these community banks now are having a lot of problems, and a lot of these banks are the ones that are writing a lot of these mortgages. So there's going to be a problem here for the housing industry. Kansas City Fed Manufacturing Index for March, not really sure here. It came out at a zero. The last month was zero. I'm not sure if this number is correct. It looks like a weak number, but I don't really have much data on it. But I pulled it up. I already went over the balance sheet. Durable goods came out today, and another weak number. So the January number for durable goods was initially reported at minus 4.5. Came out at minus 5. So that number is now worse than they originally told us. They had expected an improvement in February. It was supposed to be positive 1.5. Well, they were right. It was an improvement, but it wasn't into positive territory. We got minus 1% for durable goods in February. So back-to-back negative numbers. If you take out transportation, they were looking for a gain of 0.3. Instead, we got 0. And core capital goods, which was supposed to come out, well, actually, I don't know what it was supposed to come out. It came out at 0.2. But we did downwardly revise the prior month, which was originally reported as 0.8, and it ended up being revised to 0.3. The one number that had some strength in it was the PMI that we got today for March. And so this has some part of March in it. And it came out at 53.3. I don't know what they were expecting, but I know that the manufacturing part beat expectations. It was supposed to be 47.2, and it came out at 49.3. Now, it's still sub 50, which still indicates contraction, but not as big a contraction. And the service number was much stronger. They were looking for 50.3, and we got 53.8, which was a much stronger number than forecast. And I think the main reason for that is prices. I think in the service sector, we're really starting to see momentum building in price increases. And I think that's really what's going on with that stronger number. I think it's just higher prices that are responsible for the increase. Now, there was a temporary decline in the goods prices because we had a decline in energy and other commodity prices as the Fed had tightened, and that was taking its initial effect. But now that the Fed has eased, right, now that there are no more rate hikes, yes, Powell raised rates by 25 basis points because I guess he said he was going to raise and he didn't want to not raise. But now that he's told everybody that he's not sure what he's going to do now, right? It's like we don't really know what's going on in the future. There's a lot of uncertainty. So he, as I said in my last podcast, he's opened the door to not hiking rates, which means he's not going to hike rates because the market is going to make sure that they push the Fed through that door and there are no rate hikes. So the rate hikes are over. The only question is, when is the next rate cut and how low will the Fed be able to take rates? I don't think they're going to get all the way down to zero again. I don't even think they'll get down to 1%. They will cut rates. They're just not going to be able to cut them that much because inflation is going to explode. And so that will, shorten the easing cycle. But of course, as inflation gets worse, that accelerates the amount of ease because not only are you lowering rates, but real rates are dropping even faster because as you're cutting rates, inflation is going up. And so the gap between yield and inflation just widens. But we're going to cut rates. Haven't done that yet. But just telegraphing to the market that you're done, that counts as a pivot as far as I'm concerned. I mean, is it a soft pivot because they haven't actually cut rates? Maybe. I don't know. I just think it's about as clear a sign as you're going to get. So anybody who's still looking for a pivot, you're mistaken. You got your pivot. It's here, right? And so you're just risking losing a lot by waiting for some official pivot before you change your investment strategy, to a defensive one against inflation because you're waiting for the Fed to really start cutting rates or cranking up the presses. They've already done that, right? But when it comes to quantitative tightening, that's gone. And not only did they stop quantitative tightening, they started quantitative easing. So what more evidence of a pivot do you need than that when it comes to what they're doing with money? Now, the Fed is denying, as I said on my last podcast, they're denying that this is QE because they're saying the intentions are different. So that's what makes QE, what your intention is. So QE is when you print money and buy government bonds and mortgages if your intent is to lower interest rates. But if you do the exact same thing, but you have a different intent, well, then it's not QE. Well, that makes no sense whatsoever, right? So it is QE. I don't care what these guys want to call it. And the only reason they call it QE is because they don't want to call it the only reason they call it QE is because they don't want to call it what it actually is, and that is inflation. And that's what they've been creating, and that's why we have this inflation problem, and that's why this problem is about to get a lot worse because the Fed has no choice. And in fact, Powell admitted that in the Q&A in a way when he refused to give any economic advice to Congress. He refused to criticize any of their policies. He just said, we take whatever fiscal policy we get and we just build it into our model and we just do our best. Well, that means inflation. If they've just got to take any deficits that Congress wants to hand them and they got to figure out, how to deal with it, well, they're going to print money. I don't care what they call it, QE, it's inflation. Even if it's not QE, it's still inflation. It's about to accelerate. And so everybody needs to do something now. Don't wait. Do it now. Yes, the price of gold is still below 2,000. It got above 2,000 a little bit intraday today, but it did sell off. Let me see where it ended up closing. It couldn't hold 2,000. Gold sold off close to 20 bucks. So it closed at 1972. Still a pretty strong close. Gold stocks shrugged off the drop in gold for a change and actually were positive on the day. So investors are now starting to buy some gold stocks, realizing that they're still super cheap given where gold already is. But most of these gold stock investors still expect the price of gold to go down as soon as this crisis is over. And again, they think that inflation is going to come down. It's not. Inflation is going to run out of control. But gold is strong. Yes, it hasn't closed above 2,000 yet. It will. I don't think there's much downside left. I don't think we're going to see 1,800 again. I think that ship has sailed. So I think if you got your eyes on prices that low, you're not going to be a buyer. You got to be willing to buy stock, gold here in the 1900s. I think buying below 2,000 is going to be a good price. You're going to look back at this a year or two from now and think of how cheap gold was when it was still below $2,000 an ounce. So you want to buy some physical gold. I know the guys at Schiff Gold, they're still working overtime. They're working weekends. They're taking your orders at schiffgold.com. And, talk to the representatives at Europe Pacific Asset Management about getting your portfolios in order, transferring your accounts over. I don't know how much time we have left. I mean, I really think we're rapidly approaching the end of this, where the window is going to shut, right? And you have to have your financial house in order. You have to have all of...
No, the last stop prior to being in Athens, where I am right now, was in Santorini, and it really is beautiful. It's been a long time since I've been to Santorini, and it is the most beautiful of the Greek islands, I think, of the ones I've been to. And so if you're looking for a place to go in Greece, I would highly recommend it. It is very hot here right now. There's a heat wave. I tried to visit the Acropolis. We went to the museum, which the last time I was actually in Athens was a while ago. This museum was not even here. So I was able to see this museum this time. It really is a good museum. But I wanted to take my wife up to the top of the Acropolis, where you have the Parthenon and some other structures up there, thousands of years old. Yes, it's very hot, but we, like a lot of other tourists who were here, were lined up at 5:30, which was when the Acropolis was supposed to reopen. And we were informed that the government workers who collect the tickets, and we'd actually already bought our tickets that day. We went online, to skip the line. We paid for the tickets to climb up top there. And we were informed by other tourists. There was no official mention. They didn't even bother to put up a post that government workers decided to go on strike because it was too hot. Now, I read an article about it, and these government workers were claiming it was 113 degrees. It wasn't anywhere near 113 degrees. I was there. I was looking at, my weather app, and it was 98. It was, obviously it was warm, but from what I could tell, the government workers were going to be in these little, rooms that were sheltered. They were in the shade. Maybe, I don't know if they had air conditioning or they had fans, but it wasn't that hot. I mean, there were plenty of tourists that were going to brave the elements to pay money to climb up to the top. And we had been walking around all day in that heat. It's not that bad. And of course, if any of them had to stand in the sun, they could have, had an umbrella, parasol, whatever, and they could have stayed in the shade. It wasn't that big a deal. There are plenty of private sector workers who showed up to work in Athens. It wasn't like, nobody was in the stores. We were going to restaurants. Somebody had to deliver the food. So people who, collect paychecks in the private sector, they had no problem braving the elements. But these government workers just decided that they're going to take advantage of the hot weather to have a vacation with pay and really don't care, about the customers. And, this is another problem with government and socialism. In capitalism, the customer is always right because the customer can take their business someplace else. And when you are running a business, you need customers. You can't piss off your customers. Even if they're wrong, they're right. That's where the expression comes from. You got to suck it up, right? And you got to accommodate the customers if you want them to keep coming back, because under capitalism, it's all voluntary. None of your customers have to do business with you. They can do business with one of your competitors. And so you got to treat them nice. Even when they're wrong, they're right. The beauty of capitalism, right? Everybody is out to please you. Everybody wants to satisfy you because they don't want to lose your business. But government is all about force and coercion. They don't give a damn about the customer, the taxpayer. So when you have a government-run attraction, doesn't matter. They could be as rude as they want. They could just, not show up. You had a lot of people, very disappointed people, who came to Greece, came to Athens. They wanted to see this attraction. I talked to several people, who couldn't come back tomorrow just in case these government workers decided they didn't want to go on strike. Same with, my wife and I, we're leaving tomorrow morning. So this was our one opportunity, to see this, attraction. it's not like we're in Athens all the time. It's a long way to travel to get down here. And there are some other people that, may never come here again. And they wanted to, go up there. You would think tourism is a big industry in Greece. But again, governments don't give a damn. It doesn't matter. It's not their money. They couldn't care less. It's the taxpayers' money. They don't care if you take your business someplace else. They don't make any money on it. See, if I'm a businessman, I need to earn a profit. I need to stay in business. I'm going to make sure my workers show up, and my workers know that they need to keep me in business so they can keep their jobs, right? The workers understand how important the customers are, because without the customers, they don't have a job. But when you work for government, it doesn't matter about the customers. The taxpayers are going to pay your salary whether you have any customers or not, right? That's why, you go to the post office, although even postal workers, I think, will work in the hot weather, right? That's, their motto. I mean, it's sleet and gloom of night, or I forget what the Postal Service motto is, but they don't care about the temperature. So they'll deliver the mail even if it's hot. But if you work, in Athens, the hot weather is your ticket to a day off. But the government workers, it doesn't matter. They can't lose their jobs if they lose their customers, because they're going to get paid no matter what. They're going to get paid by the government. The bill is being passed on to the taxpayer. So that is a little lesson today. I recorded a short Instagram. I don't know if you don't follow me on Instagram, you should do that. I mean, I come up with some interesting stories that I put out there on Instagram. I don't have nearly as many Instagram followers. I have over 100,000 of them, but it's nothing like, close to the million followers I have on Twitter. But it's still worth following me over there, because I put up some interesting content, like the video that I did, live today from the foot of the Acropolis. Some people have been following my wife on Instagram, and she posts a lot more stuff. A lot of our vacation is up there, although a lot of the stuff are stories, so they're only up for 24 hours. So, they go away. I don't know, maybe she'll post some longer videos. I know a lot of people who follow me have followed her, but most people haven't figured out, which site is hers. But if you're able to do that, you can see a little bit more of my vacation. I think it's Metaphor Love or something like that is her handle on Instagram. Anyway, I want to kind of get into today's podcast. Though first, I want to talk a little bit about the markets, because we finally saw some weakness in the NASDAQ, mainly yesterday. It was on Thursday, although the NASDAQ actually dropped again today. It wasn't a big decline, but on the heels of yesterday's big decline, the fact that we didn't get a bounce in the NASDAQ may be significant. And in fact, the NASDAQ was the only of major U.S. stock market index that was negative on the week. And in fact, intra-week, the NASDAQ again set a new high. And all the indexes, the Dow, S&P, they made 52-week highs. But the NASDAQ was the only one that closed the week negative. Again, it didn't get killed. I mentioned this in the last podcast, that it looks like we may be eking out a top here in the NASDAQ. And the news that disappointed the markets yesterday, I think came from Taiwan Semiconductor. And they basically warned that sales were going to be weaker than they thought. Now, this really threw some cold water on the AI narrative, because, they make chips, and, there's supposed to be a lot more demand for chips when everybody is ramping up AI. And so this kind of let some air out of that bubble, and we saw a big drop. But also we saw warnings, I think, coming out of Netflix, which had a big drop on the day, Tesla. So, different companies in different, aspects, all, warning or having problems that they're looking at. And so that weighed on the NASDAQ. And so we'll see if we get some more follow through next week. Again, I've been talking about the fact that the market is way overextended on this podcast, but also more importantly, the market is still not coming to terms with the reality of inflation. In fact, another good example of the inflation problem is in Japan. And again, not that many people are talking about the inflation problem in Japan. And it's not just the inflation problem, it's the interest rate and government debt problem. And there was a slight decline in the June numbers from 4.3 to 4.2, but still now you're talking about core inflation, right, in Japan, better than 4%. Now, for years, the Japanese government was telling the Japanese people that the problem in Japan was not enough inflation. Of course, that wasn't the problem. That was one of the bright spots of the Japanese economy, that at least they didn't have a rising cost of living, or at least the cost of living was rising very slowly. But the Japanese government said, no, we need more inflation. The only reason we don't have a stronger economy is inflation was too low. That was the lie that they continued to tell. And under the pretext of that lie, the Bank of Japan printed tremendous amounts of Japanese yen and used that Japanese yen to buy up government bonds. And that enabled the Japanese government to go into debt, selling those bonds to the JGB. The problem now is that they've succeeded beyond their expectations in raising the inflation rate, because their goal was 2%. Well, they've clearly overshot it. In fact, based on the official numbers, this is the first time in 8 years that headline inflation in Japan is higher than the US, because our headline number, not our core, just the headline, is 3%. So in Japan, you're at 3.3. That's 10% greater. But what happened the other day is the Japanese government, or the Bank of Japan, came out and reiterated their commitment to achieving their 2% inflation goal, as if they haven't done it yet. Apparently, the Bank of Japan is still not convinced that inflation is high enough to qualify for 2%, even though we're at 3.3 and rising. And so to make sure that we've got 2% inflation and it's here to stay, even though it's 50% higher than that, the Bank of Japan is committing itself to maintaining negative interest rates. They still have short-term interest rates, negative 10 basis points. In the face of rising inflation, well north of 2%, they still have the pedal to the metal saying we need more inflation. We're not convinced that inflation is here to stay. And in fact, the Bank of Japan reiterated their commitment to control the yield curve control on the 10-year JGB to keep yields below 0.5%. Now, the yield's 0.5%, inflation is 3.3%. What idiot would